Ciao, and welcome to a new episode of helping you build wealth through real estate brick by brick. I'm Nico James BoC, founder of the CondoWiz Group and broker at Keller Williams Empowered Realty here in Toronto. On January 29th, 2026, the Bank of Canada held its policy rate at 2.25%. And this decision matters far more than most headlines suggest. This level sits at the very bottom of what the bank considers neutral, meaning monetary policy is no longer stimulating the economy, but it is no longer actively restraining it either. Inflation came in at 2.1% in 2025. Core inflation continues to ease toward 2.5%, and the bank has made it clear that interest rates have largely done their job. This pause is not hesitation. It reflects limits. From here, monetary policy is stepping back, and the next phase of the economy will be shaped by trade outcomes, fiscal spending, business confidence, and housing supply. In this episode, we're going to unpack what that shift really means and how it sets the stage for real estate's next phase. Trade, tariffs, and structural risk. The real risk facing Canada right now is not inflation, it's trade. US tariffs have already weakened exports, particularly steel, aluminum, and automobiles. While Canada is diversifying trade and increasing exports to markets like China, there is no replacement for the US in terms of scale, speed, or cost efficiency. The upcoming CUSMA review is the single biggest unknown in the economic outlook. An unfavorable outcome would ripple through production, hiring, and GDP, and that is why the bank is staying flexible rather than aggressive. Jobs and the labor market. Employment weakened in early 2025 as tariff-exposed sectors cut back. But recent job gains in healthcare and services have helped stabilize the picture. Population growth is slowing, which reduces pressure on job creation. But business surveys show something more concerning. More firms are planning job cuts now than during the pandemic, signaling a structural slowdown rather than a temporary shock. Wages are still rising, but the margin of error is shrinking. Bonds, mortgages, and market signals. Even with the policy rate on hold, market-driven rates are rising. The 5-year bond yield is pushing toward 3%. The 2-year yield sits well above the overnight lending rate, and lenders have already raised fixed mortgage rates. This tells us the market is pricing in persistence, not relief. If households expect rates to stay higher for longer, fixed rates become more attractive, even without further rate hikes. The bank may be paused, but financial conditions are still tightening at the edges. Condo market reality check. The condo market is deep into a correction. New condo sales in the GTHA hit their lowest level since 1991. Down 60% year over year, and nearly 90% below the 10-year average. Project cancellations have doubled. Construction starts are down sharply, and completed but unsold inventory has surged. Investors are favoring newly completed units over pre-construction, while purpose-built rentals are absorbing capital through government incentives. This is painful, but it also sets the stage for a future supply shortage once demand returns. Canadian household debt just hit $3.2 trillion. But the key detail is that growth is slowing and much of it is interest-driven, not discretionary spending. That tells us households are treading water, not accelerating. Consumer confidence in the US just fell to a 12-year low. And while Canada is different, sentiment matters. When people feel uncertain, they delay decisions, which slows housing, spending, and investment even if rates are stable. Addressing fears head on. There's a lot of noise right now. Fears of collapsing prices, stalled sales, global conflict, and economic instability. History shows that housing corrections are not linear crashes. They are drawn out resets. Prices adjust, activity slows, weaker projects disappear completely, and stronger fundamentals survive. This environment rewards patience, liquidity, and selectivity. The biggest risk is not buying or selling. It's making decisions driven by fear instead of strategy. The Bank of Canada has reached the limit of what interest rates alone can fix. But that does not mean the outlook is bleak. What it signals is a shift into a more deliberate phase for the economy. Growth is expected to recover modestly over the next 2 years, supported by rising infrastructure spending, targeted fiscal measures, and a gradual adjustment to new trade realities. Policy stability now brings something the market has been missing: clarity. Businesses can plan, households can make longer-term decisions, and capital can begin moving toward productive investment rather than short-term survival. In real estate, this environment favors fundamentals over speculation, quality over volume, and strategy over speed. This next phase will not reward impatience or headline chasing, but it will reward preparation, strong balance sheets, and informed decision-making. Housing demand has not disappeared. Long-term supply pressures remain, and the reset underway, while uncomfortable, is helping lay the foundation for a healthier and more sustainable cycle ahead. Next, key dates. The employment report is on February the 7th. The inflation CPI report comes in on February the 18th. The monthly GDP report, or their numbers, come in at the end of February on the 28th. The next Bank of Canada rate decision is on March the 12th. There is no decision in February, which is skipped. Housing is correcting, not disappearing. The opportunity over the next 12 to 36 months will belong to people who understand cycles, stay informed, and act deliberately. If this conversation helped you cut through the noise, like it, share it, comment with your questions, and reach out if you want to talk about how this environment affects your next move, brick by brick. Ciao, ciao.